Talking about earnings, it was a mixed quarter for Shriram Transport Finance. While the net interest income saw robust growth, the bottom line remained pretty much muted. Let's discuss the quarter gone by with Mr. Umesh Revankar, the MD and CEO of the company, and also joining us is Shraddha Babla from our research team to take this conversation forward. Shraddha, over to you.
Thanks, Navneet, and good morning, Mr. Revankar. Do you expect the CV upcycle to continue in FY19 as well, and will growth be driven by new commercial vehicle financing in FY19 as compared to used CVs?
Going forward next year, I feel the demand for the CV is continuing to be good, both CV and construction equipment. And our focus, of course, would be on used vehicle only. Only if our existing customer want to upgrade their into new vehicle, we would be lending to new vehicle. So focus would be on used vehicle, especially because we have opened 295 branches in the last financial year, and another 200 we are going to open this financial year. And all of these centers are in the rural area. So we expect in the rural area the demand for the used vehicle should be good. So even though we continue to lend the new vehicle as and when our customer upgrades, our focus would be on the new vehicle only, used vehicle only, sorry.
Okay, so then what kind of AUM growth do you believe you can do in FY19?
The AUM growth should be around 18 to 20% in the next financial year. We expect good demand in the first quarter of this year because the winter crop has been good, and overall the demand for the vehicle credit is quite good in the first quarter. Maybe second quarter, due to rains, there could be some slow movement. But again, we expect third and fourth quarter to be very good, because if the construction activities remains high, cement and steel movement will add further to the requirement. So we expect overall the demand to be quite good in the next financial year.
Fantastic. And now that the transition to the 90 days past due basis NPA recognition norms is done, can we expect the underlying trends in asset quality to improve from here on?
Yes, definitely, because we just moved into 90 days. When we first time move into 90 days, there will be a fresh NPL formation that's happening because of the accounting policy. But now, since we have crossed the final hurdle, now onwards you should come down. We expect around 50-60 basis point improvement in the gross NPLs, and that should help us to reduce our credit cost as well in the next financial year.
Okay, and then can we expect any improvement in the interest rate spreads? Are you looking at any tweak in the lending rates to offset that higher market borrowing rates?
The interest rates are likely to move up is the indication initially we have now presently. We are not sure how it will play, but 50-60 basis point increase is what we are estimating. If it is at this level, we should be able to pass on some to the customer easily and maintain the net interest margin, because most of our expansion has been in the rural market, and rural market plus used vehicle, we should be able to pass it on to the customer, because we don't really see a big challenge as far as passing out on to the customer.
Okay, and is it fair then to assume that your OPEX will continue to rise gradually on account of that new employee and branch additions?
Yes, but it will be proportional to the increase of AUM, so it will not really have a pressure on our margins. So our cost-to-income ratio, which is around 21%, we should be able to manage at 22% in the next financial year.